What we were just talking about, the Chinese targeting specifically not just types of chemicals, ethylene glycol, diethylene glycol, but companies, Dow Chemical, Equistar, Eastman, Ineos, Sasol. What does that say to you?
Well, I think the real key for a lot of these tariffs is not the specific targeting, but remember, as part of the tax reform, they had a provision that encouraged companies to do capital spending. But when you have overhangs of maybe I'm going to be levied against tariffs against me, there's not going to be a lot of reason for these companies to plan ahead and spend.
This could hold back CapEx is what you're saying.
And so I think this creates the risk to growth, and growth expectations are already quite high for this year and next.
What I find really interesting here is that point that Martin just raised, and I think that's key. You know, when we've heard from the US, we've heard the US is targeting tariffs on aluminium, on steel. The US doesn't say I'm going to target X company or Y company, but the fact that China's talking about something very specific, but then is also really pointing to the exact companies that are going to feel the impact, seems to me that they've just taken a slightly different negotiating tactic, which is one that is going to hurt.
Well, I think the approach that they've taken is perhaps one that might work better with this president. Because those companies and those presidents of those companies are going to call the White House and say, look, we're being directly targeted, we're being directly affected.
Get them off our backs.
Get them off our backs. As opposed to a very broad tariff where it's impacting a few people a little bit. This one, I think, is meant to politically hurt Trump.
Norman, there are a number of challenges that the markets are facing right now. You've got trade and all that uncertainty that that's creating. You've got a possible major re-rating of the tech sector. You've got a LIBOR, which is creeping higher as well. And on top of that, come Friday, if we do get inflation in the wage component of the payrolls, then that's going to give rise to volatility in the rates market. How do we approach these markets then at this very critical juncture? Do we adopt a more defensive posture?
I mean, we've been adopting a more defensive posture, but I think the real challenge for investors is historically adopting a more defensive posture meant buying bonds, buying government bonds. But with yields so low, that's really not a credible alternative for most people right now.
Still watching? Perfect. Click here to watch another great video from CNBC International. Oh, and don't forget to subscribe. Thanks for watching.